There are several indicators that point to an optimistic end of year performance for the S&P 500. Since World War II, from the low point in October until the end of the year of every calendar year since 1945, the S&P gained an average of 7.2% and was higher 92% of those 75 years. Second, we recorded a new all-time high in October. And whenever that has happened, the market has risen about 3.5% in November and has done so 75% of the time. We've had 25 of those occurrences since World War II. Both of these statistics are obviously much better than the average for all observations going back to World War II. Also, what we found is that year to date through October, the S&P gained 22.6%, which ranks at number 8 since World War II. And for the top 10 prior, the market was then higher 6% through the end of the year and was up 100% of the time. And even if you dip into the top 20 year-to-date performances through the end of the year, the market was higher 19 of 20 times, and it was up 4.8%. So history basically says if you have a lot of momentum behind the market, that momentum is going to be very hard to upend. And with earnings coming in as strong as they are, I don't think investors are going to want to bail out of stocks before the year end. I think that if any investor is surprised by the Fed adopting a tapering program at this upcoming FOMC meeting, they should change their name to Rip Van Winkle because they have been asleep. The Fed has been doing a wonderful job telegraphing what it is thinking about doing, what it's planning on doing, and now what it is likely to do. So Wall Street has already factored that in to their forecasts and their opinion. Our belief is that the Fed will start its tapering program, will do so through the middle of next year, and people are talking about the Fed raising rates in the latter part of 2022 as early as September. But I really sort of question that because there is so much debt out there that's owned by the U.S. government that they would just be creating a gigantic hole for themselves from which they would not be able to climb out. Well, I think that the inflation worries continue to be focused on supply disruptions, not really on the Fed's easy money policy. I think that investors are going to continue to worry about inflation until the beginning of 2022 because our forecast is that the highest year-on-year number will come out to reflect the December data. So we really won't start to see the inflation numbers start to ease until we move into 2022. So yes, I think inflation could continue to be a concern for investors through year end, but I think in the long run, the Fed will be proven correct that it will be transitory. It'll just take longer for it to transition back to what it was. The November and December are two what I call seasonal sweet spots of the year. In terms of frequency of advance, the market doesn't do any better than it does in November. In terms of average price gain, it doesn't do any better than it does in December. In terms of volatility, very low in the final 2 months of the year. So in a sense, investors are getting an early holiday gift by investing in the market in the beginning of November and at least holding on until the end of December. And January is not bad either because those investors that did sell before year end in order to harvest tax losses then tend to put that money back to work in the beginning of the new calendar year. Well, I think the preference would be on the cyclical sectors. You're familiar with the old adage of sell in May and go away. Well, that 6-month period ended on October 31st. So instead of traditionally leaning defensively in May through October, now history says you are better off gravitating toward the cyclical sectors such as consumer discretionary, industrials, materials, and tech. Those 4 sectors together have beaten the market by about an average of 250 basis points for each of those 6 month periods since 1990. And the frequency of outperforming the market has been about 3 out of every 4 years. So, not a guarantee, but it certainly does imply that investors tend to gravitate toward the more growth, cyclically biased companies and sectors than embracing the defensive ones.